How's it going, everybody? Like Pat said, my name's Walter Zinenko. I'm a manager in our digital asset practice at EisnerAmper. In my role, I work with crypto-native companies to assist them to account for complex transactions. Thanks, Pat. So that's what we'll do today, is explore layer 2 revenue recognition with our favorite things as CPAs, journal entries. So first, I want to just frame everyone for this discussion. So if I could rename this talk, it would be the theory of relativity, a crypto perspective, a crypto accounting perspective. So if you don't know, the theory of relativity explains how time is impacted by speed and gravity, and my boy Bert laid it out in some fancy equations. And I think that's a good analogy for today because it explains, or it's an analogy, for how crypto can impact your financials. In other words, if you are transacting in a token that's rapidly increasing in price or experiencing volatility, that has an impact to your overall financials. And as accountants, we need to account for that. So let's do it. So some basic 606 concepts. I won't bore everyone, but we just need some foundational concepts here. So ASC 606, if you don't know, GAAP lays out revenue recognition policies in this ASC, and it has a 5-step model. First, identify your contract, your customer, the performance obligations of that contract, identify a price, and then allocate that price to each performance obligation. And as you perform each obligation, you're then allowed to recognize revenue. The second one is generally everyone, this I think should make sense to everyone, but 606 does get tricky, so this is just a general kind of overview of how you should report your financials. So for revenue recognition, I think it makes sense to an investor, to a shareholder, that all the expenses included in creating that revenue to generate that revenue should be included in the same period on the same financials. Otherwise, it's very difficult to back into what the company's doing, what's making it profitable, or what's driving losses. So generally, you should be accounting for expenses and revenue in the same period. There are practical expedients that allow for expenses to be over time or as incurred if there's shorter term contracts, but we'll ignore that for this talk. And then the last thing is embedded derivatives. So this is a concept that all crypto native companies come across. Whether they like to address it or not is a different thing, but within your revenue contract, GAAP says that you should account for changes to cash flow because of an underlying variable, a token, an interest rate, a commodity price, separately from the overall revenue. So let's explore that with some journal entries. Simple revenue transaction. Every CPA, raise your hand if you're a CPA in the audience. Okay, we have some. We all know widgets for crypto natives. Pretend these are NFTs. We'll just go through a few basic journal entries to account for the cost and revenue associated with some type of contract. So in this case, we've put in man hours or some kind of raw material, and then we've capitalized that cost. So going back to matching, we haven't sold that widget or NFT or chair or what have you yet. So now we want to account for it, but we don't want to put that on our P&L. So step 2, if we record that revenue, so we've sold that widget, we can put that on our P&L as a sale. Our gross profit here is $4,000. Great, we're doing great. And our cost is now recognized in the same period as the revenue. So this should be very straightforward. Now let's add one more layer of crypto onto this contract and see how it impacts the overall business. So first thing, nothing changes, right? We've still created something. We've still accounted for the cost. Right now, we're not recognizing that cost. We haven't performed the obligation associated with this contract. Step 2, we sold the widget. In this case, the underlying of the contract is in Ethereum. So in this case, these two entries are exactly the same as the last, but now we have an embedded derivative that we want to account for. So at the time of the transaction, when we sold those widgets, the value of those tokens, 1.5 Ethereum that the contract's denominated in, was worth $5,000. So these journal entries haven't changed. What changes is the cash flow when you actually collect those tokens and have to account for it in US dollars. So again, if we set the theory of relativity, our business is now impacted by the volatility of an underlying asset that we have no control over. And what GAAP says, FASB says, is to account for that separately so that investors and shareholders can understand the nature of your business. So your gross profit hasn't changed, but because of business decisions that your company's made, you've made less US dollar income, essentially. Okay, that was the basics. Hopefully this is not over everyone's head. We'll get back to the journal entries for the CPAs, don't get too scared. But we're gonna talk about layer 2 networks. So in 30 seconds, what a layer 2 network is essentially a separate blockchain or some type of protocol that settles onto a base or foundation layer. The reason they do this typically is to leverage the security of the underlying base layer. And they leverage lower cost on their blockchain, or they secure the information within their layer 2. So there's various use cases here. But what we'll explore today is really just the performance obligations for these protocols. Could it be that that performance contract with users of your layer 2 who are paying you to transact on your chain? Could it be at that layer 2 level when you bundle their transactions, put them in a layer 2 block and say, okay, here are your transactions? Or is it actually when that information is settled, committed, rolled up to the layer 1? Or is it both? So let's go through the same type of thing, a journal entry for, first we'll say that that performance obligation is on the layer 1, that base layer. So we might have collected fees up front, and because we haven't fulfilled the performance obligation, we defer that revenue. So again, simple, but the issue is that these are now denominated in tokens and not US dollars, and you have to account for both the tokens that you've received as well as the ongoing obligation, which might fluctuate based on the price of the tokens that you've received. So in this case, we've created a block on our layer 2 network. We've earned 100 ARB tokens. These are round number prices. Don't look at CoinMarketCap because this is not accurate, so don't sell. But so we account for it on the date and time we've received these tokens. So this varies slightly from our earlier example where we've performed an obligation and then we collect. In this case, we collect up front, and it's a different approach for recognizing revenue and accounting for those transactions. So we've received tokens, we put that on our balance sheet. We now have an ongoing liability to perform some obligation within the contract. Step 2 is to settle onto the layer 1, right? So we've created the layer 2 block, we've collected fees, and now we say we've performed our obligation, and now we can recognize revenue. The important thing here to understand is that revenue hasn't changed from the origination of the contract. So it's still $5,000 on your financials, on your top line revenue. Down here, you can see the cost associated to settling to that layer 1, Ethereum gas fees or blob fees or what have you. But what does get impacted, the items in red here, it's the change in value of those tokens on the date that you perform the obligation. So when we originally received the tokens, which might have happened an hour, a day, a month before we actually settled to layer 1, those tokens were worth $50 per token. We received 100, $5,000. When we've actually performed or settled to layer 1, the price of those tokens dipped to $30, and now we have to account for that separately on the P&L. And again, the thought process here is that your revenue is $5,000. That's what was agreed to by the customer. And now it's up to the business to mitigate or hedge against the volatility risk that is operating with tokens. And then the second example here would be, let's pretend that there's actually 2 performance obligations. So if we were to say that our only performance obligation is creating the layer 2 block, but as an accountant or auditor, you're telling me that at some point in the future, I'm also going to do some other part to settle this contract. What I would argue is that you probably have 2 performance obligations that need to be accounted for separately. So going back to the slide on ASC 606, that's when you would separately define those performance obligations and account for them separately. You would price them separately. You would allocate the contract price to those items, and then you would record revenue as earned. So instead, if we say, let's get this. If we say that we have 2 ongoing performance obligations, the first is to create the layer 2 block. Well, great, that happens almost immediately upon you collecting those tokens. So we still receive 100 ARP tokens at $50, $5,000 on our balance sheet as digital assets. And then we recognize revenue for the allocated price of that contract for the layer 2 settlement. And we defer the remaining amount until we've settled onto the layer 1. The same sort of thing happens here. You'll see that you record revenue at the fair market value on the inception of the contract, but there's a separate P&L hit based on the volatility of the token. So 50 from 50 per ARB to 30. I think the thing that you should take away from this is that as you operate on chain, there are other things happening on your balance sheet and income statement that affect your operations, your cash flows that investors and shareholders want to understand and learn more about so they understand how profitable, how viable your business is. And this is something that we have to work through with crypto native companies all the time, right? So they might just be saying, oh, we're doing this, we're making money, but it's not until you go through these steps and these journal entries that you really understand the impact to your overall business. So hopefully that gives you a glimpse into the types of things we do with crypto native companies and accounting for them. I never looked at the time.
Perfect.
Cool.
Amazing. And I love, by the way, I love this talk because at the end of the day, it was the L2 example here, but it accounts for a lot of different things from like gaming to token sales. So like a lot, we're seeing more and more gambling companies. We're talking about Polymarket. Like all of these guys have some flavor of this they have to pick up. And then of course, like the embedded derivative that's denoted in, that's denominated in the actual cryptocurrency, it creates all those knock-on effects. Awesome talk. Thank you so much. Thanks so much, brother.
Thanks, guys.